Why do we need stops? Now, at Tradelo, we do put risk management at the forefront of every single trading decision. When you use the Tradelo automatic risk system, you will always need to first input a stop. And this is done by design because it's forcing you to think about the absolute worst case scenario. If you know beforehand what the worst possible outcome is, you will likely commit to that trade. This approach to trading is what differentiates winners and losers. Now, over the course of this topic, you're going to understand why. Now, thinking about risk before executing a trade is unique because as traders, we instinctively want to click buy and sell. It comes naturally. We just simply want to enter the trade and then suddenly we want to start thinking about worst case scenarios. Where should I place a stop? How much am I going to lose? The problem with acting instinctively is it simply doesn't safeguard us in the long run. That's just the reality that will become quite apparent over this topic. Now, so often in mentoring sessions I do with the traders, what I hear more often than not is a trader tells me how, for 3-4 weeks, they were building consistently, their account was going up a little bit, they're making some good gains, and then all of a sudden in one trade or one day, they lost it all. And I see this time and time again with traders. The reality is that you may get away with not managing risk a few times, and you may make some money as a result. And you may think that, wow, you've got this all figured out. Risk management is, sort of secondary in terms of priorities. But the reality is at some point, you're going to run headfirst into a big loss. That's just how it always works. You'll do a couple of trades, you'll build a bit of traction, and then suddenly you're going to lose it all. And I see this time and time and time again. The point is your luck does run out, okay? If you are not managing risk first and foremost, at some point you're going to get caught out, you're going to lose it all. And eventually you're going to come to me and you're going to say, you know what, I should have just listened to you. I should have started to put risk management at the forefront of every trading decision, okay? Now, what I want to address in this topic is why we're using trading stops. And rather than take this one-sided view of just saying you have to do it, you have to do it, you have to do it, I want to take it from the standpoint of showcasing what the upside is, what the benefits are, but I also want to invite in some of the drawbacks because yes, there is a drawback to using a stop and we have to address those. But hopefully by showcasing both sides of the argument, you'll very quickly understand why it is necessary to use stops and make sure that risk management is predetermined and done before execution. Okay, let's start and talk about the key benefits. The first one is the obvious one. Okay, with risk management, we have stop loss limits, okay? And we know effectively the maximum amount we are going to lose at any given moment, whether that's a day trading stop loss limit, whether that's a single trade loss limit. The point is it ensures that losses are within a predetermined parameter. This means we've accepted the result and it ultimately prevents emotional decision making, okay? And that's absolutely paramount, and that's one of the key benefits of risk management. Second is capital preservation. If we stop at predetermined levels every single day, ultimately the stop loss is helping us protect trading capital in the long run. And this is crucial for maintaining longevity in trading and avoiding those significant drawdowns that jeopardize our future trading opportunities. Also, confidence preservation. Okay, this is something that traders don't talk about enough. You need skill as a trader, okay? That's paramount. But also, to perform optimally, you need to ultimately absolutely trust in your decision-making process. Now, when you have that big drawdown, ultimately what happens is you lose trust, you lose confidence, and ultimately you get rid of all that momentum you've built up over time, okay? So confidence preservation is crucial, and we can do that ultimately by using stops. We've got the psychological benefit. Okay, knowing that there is a limit to the daily loss or the loss on any trade reduces the fear associated with losing. If you want to get comfortable with losing, try losing an amount of money that isn't detrimental to your account. Okay, this is a fascinating exercise. If I said to you, you're going to lose $10 on a trade, you'd look at me and you laugh. You say, oh, $10 on a trade? Wow, I paid that in commissions for 2 trades. Right? And that's the point, is that when the loss is predetermined and when it's accepted, you can become very comfortable with that loss. And that means you become very comfortable losing. And if you're comfortable losing, you stop focusing on outcomes and you start focusing more on process. Okay, when you're focusing on process and you're honing in that process and you're developing that process, the outcomes start to take care of themselves. Okay, another one, trading intervention. This is something not enough traders talk about. With risk management or using stops, we've got this natural trading intervention. And what I mean by this is that the markets never stop flowing. They're open pretty much 24 hours a day, okay? They are constant. And if you've ever wondered why you suddenly overtrade despite your best intentions not to, it's because of that constant ebb and flow of the markets, okay? The markets are designed to draw you in and participate. That's the job of a market. Now, ultimately, when we have stop management, what this does is it's a natural pause because I'm in a trade, bang, the stop gets hit. Well, now I have to pause. I have to take a step back. Something is intervening in the natural ebb and flow of what's going on in my head. Okay. Now, ultimately, when we have these stops in place, what you should do is you should be taking a step back and saying, hang on a sec, that hit my stop, therefore my idea was wrong. You should almost have a sense of relief, but I see the opposite in so many traders. They get hit on a stop and there's this instinct of frustration. There's this instinct of like, it's unfair or it's wrong. The reality is using a stop ultimately is an intervention with the market saying, you got it wrong, buddy. And that's your opportunity to take a step back, take a deep breath, and start all over again with the next trade. Okay. More importantly, when it comes to daily stops, it's a massive intervention because if you're hitting a daily stop, what it's telling you is that you are off today. You're out of rhythm. You're not trading well. Don't take that personally. Don't take it as anything other than what it is. The market is telling you something objective. Okay, and it's important that you recognize stops ultimately is a form of very positive intervention for us. Okay, and then finally, consistent application. The number one reason traders fail, above all else, is because they approach the market with a different process every single day. Okay, and it's the same with risk management. If you're using risk management and you're applying the same framework day in, day out, in other words, you're consistently applying the same approach day in, day out, this will remove the ability for you to be volatile in how you make decisions. Okay. Now, if you remove volatility from your decision-making process, think about what happens to your trading results. They will also eliminate unwanted volatility. Okay, and that's the key. It's about consistently applying ourselves, being capable of making the same decision today, tomorrow, the next day, based on the information coming in the hand. Okay, and stop management allows us to do this. It allows us to be consistent in how we make decisions. Now, something that I use as coping mechanism, and this is quite a cool little exercise that you can go and think about. Okay, I want you to think about the biggest drawdown you've had recently. Okay, take a big drawdown and try and sort of cast your mind back to that drawdown and how it felt. And I want you to ask yourself this question: how many additional trade ideas could you have executed if you simply just didn't take that big drawdown? Okay, so imagine that you lost $1,000 more than you would have if you just stuck to the stop, and go and take that $1,000 and say to yourself, how many other good ideas could you have executed if you still had that $1,000? Now, this exercise works extremely well because what it does is it starts to outline the key trade-off of what happens when you're putting risk management at the forefront of every decision and when you don't have any risk management. Okay, because that's what you're giving up. You're foregoing ultimately that additional $1,000, which could have meant that you had 1, maybe 2, maybe 5, maybe 10 more trade opportunities. And that's what I want you to go and think about, because if you do that, you'll very quickly come to realize why risk management or using stops in general is so important. Now, yes, there are drawbacks to using stops. Okay, and the first is obvious: premature exits. Sometimes the markets can be volatile, and if you're using very tight stop losses, you're going to get hit on them. And then frustratingly, oh, I got hit at the low of the day and see it reversed it to exactly what I expected. I get that. It happens to all of us. It is frustrating. And it is one of the drawbacks of using stops. Okay. Stop loss discretionary decision. Okay. So often I hear traders say to me, where should I place a stop? How should I place a stop? How do I know what my daily stop should be? There is a lot of discretion involved when it comes to determining a stop. Okay, there is no hard, fast rules. Sure, I can give you a couple of rules of thumb, but the point is it's discretionary in nature. You place a stop too tight, you're likely to get stopped. You place it too loose, you're probably going to lose too much money. Okay, so that is one of the drawbacks. It is very much a discretionary process. Overtrading, okay? When we use stop losses, it does ultimately result in a higher frequency of trading, because if we're managing risk correctly and we're keeping it nice and tidy, nice and tight on the downside, ultimately we've got more opportunity to execute trades, more opportunity to get involved in the market. Right? This leads to a lot more transaction costs. And like I said to you, ultimately, the one benefit of stops is that it is a discrete pause. It says, hey, I'm intervening, you should stop now. Now, if we're over trading and we're getting involved in a lot of different trades, it's very easy to get sucked into and move away from the intervention and get sucked into the ebb and flow. Just keep trading and trading and trading. Okay. So just keep that in mind. It's a double-edged sword. And then finally, using a stop loss is a rigid approach. Okay. Daily stop or a stop on a trade, it does impose a rigid rule on trading. And it may not always align with the market conditions or your trading strategy. Okay. It might force you to exit a trade that eventually would go up or down. And ultimately, the market is constantly changing. So today you use a 10-tick stop and it works. Tomorrow you use a 10-tick stop and it doesn't work. Okay, so unfortunately, you're applying a rigid approach to ultimately a very fluid environment. Okay, so yes, there are drawbacks. Okay, but we don't want to we don't want to discount the drawbacks. That's the key message here. We don't want to ignore them because they do exist. However, objectively, for most of you, you want to make money. Okay, that is your primary objective, I suspect, for most of you. And you want to develop yourself long run as a career professional trader. Now, if this is your objective, if your primary objective is I want to do this as a job and I want to make money, the reality is you've got to keep yourself in the game for long enough. And you can only do this by applying a consistent predetermined risk management system. Okay, it's not possible to do it without it. So if that is your objective, then you need to approach it with a very constructive risk management approach. If you just want to have a crack, if you just want to try and get rich and try and get lucky, I get that. I'm not going to discount that, right? In that case, fine. Maybe risk management isn't the core priority because you do just want to have a crack and you accept that you're going to put a large part of the account in risk and hope it works out for you. But remember what I said. If you're going to approach it in that manner, you have to accept the other side of the coin, which is that the probability is you can only get lucky for so long, and at some point, you're going to get caught out. Okay? Remember, next time you take that big loss, ask yourself, was it really worth it to not have a predetermined stop in place? How many other trades ideas could you have executed if you just stuck to that stop? Top performing traders are always managing risk first. This ensures that they can go and focus on the process of trading. If I take care of risk, I'm not emotional. I don't care if I lose or win. Okay, all I care about is what was the approach I took to that trade? How can I do it better next time? If that's where my focus is as a professional trader, the positive outcomes in your trading are the byproduct. Okay, you will get the results if you're focusing on consistent, productive decision making.